If you look at any price chart, you'll notice that the price doesn't move in a straight line. It doesn't move up or down vertically. It moves in waves, and these waves are called market swings. In a bull market, price rises with a series of up and down swings. Naturally, the upswings generally exceed the downswings in length. The reverse is true in a bear market. By observing market swings, you will be able to notice the structure of the market and get clues on whether the market will move up or down. And following market swings must be your first step to read the market bias. Another way to look at market swings is to think of them as a higher time frame perspective. Each swing is equivalent to a bar in a higher time frame. This is why some traders use a higher time frame to evaluate market bias. There are two challenges with the higher time frame approach. First, the higher time frame is usually chosen arbitrarily. Common choices are multiples of 3 and 5. For instance, if your trading time frame is 1 minute, using a multiple of 5, you will use the 5-minute chart for determining the market bias. However, there is often no sound basis for the choice of the higher time frame. Next, by using a higher time frame, you must split your attention between two time frames. While some traders might find that manageable, some try to keep trading as simple as possible and focus on one chart only. By analyzing market swings, you will be able to factor in the price action of a higher order in your analysis without a second chart showing a higher time frame. The advantage of this approach is that you will be able to evaluate the ongoing price action within its larger context on the same chart. So, we will focus on reading market swings to deduce the market bias using a single time frame. So how to define market swings? The first step is to classify every price bar in one of the following 4 types: up bars, down bars, inside bars, and outside bars. These labels describe the relationship of each bar high and low relative to the previous bar. Up bars have the following characteristics: higher high and higher low compared to the previous bar. Down bars have lower high and lower low compared to the previous bar. Inside bars have lower high and higher low relative to the previous bar. And if the high or the low or both are equal to that of the previous bar, it's still considered an inside bar. And outside bars have higher high and lower low relative to the previous bar. If either the high or the low are equal to that of the previous bar, it's still an outside bar. So by using this approach, the closing price of a price bar doesn't matter in the classification. An up bar might close lower than it opened. A down bar might close higher than it opened. For a bar that closes higher, we will use the term bullish bar, and for a bar that closes lower, we will use the term bearish bar. Let's identify the candles in this example. We have 4 up bars, followed by an inside bar, another 3 up bars, and another up bar despite being a red candle because the high and the low were higher relative to the previous bar. We then have a down bar, 3 up bars, 2 down bars, and an inside bar, an up bar, then an outside bar because the high and the low are equal to that of the previous bar, so it's still an outside bar, then an up bar, an outside bar, followed by an inside bar, and another inside bar, 2 down bars, 4 up bars, an inside bar, a down bar, an inside bar, a down bar, an inside bar, and finally an outside bar. With this approach, you don't need to memorize tens of candlestick combinations, you just need these 4 types of candles. I recommend opening a chart and start reading candlesticks until it becomes very easy to determine which type is. Do this until you will be able to recognize the type of the candle almost instantly. Once you have mastered the different bar types, you will be able to identify market swings with ease with these 4 rules. An up bar starts an upswing and confirms the end of a downswing. A down bar starts a downswing and confirms the end of an upswing. Inside bars don't affect the direction of the current swing because they don't break the previous high and low. Outside bars break both the previous high and low, so it introduces uncertainty into the market structure. However, as each swing is a minor trend itself, and trends tend to continue, we give the benefit of the doubt to the current swing. Thus, outside bar in an upswing continues the upswing. Similarly, outside bars in a downswing continue the downswing. Now, we took the previous example and we marked out the market swings based on the bars that change the direction of the market swings. The circled bars are inside bars and outside bars, and they don't affect the direction of the market swings. So most swings are confirmed by an up bar or a down bar. However, under exceptional circumstances, it is possible for a swing to form without either an up bar or a down bar. An upswing can be formed when the market rises above the last swing high, without forming an up bar. Similarly, a downswing can be formed when the market falls below the last swing low, without forming a down bar. An outside bar is always involved in such cases. This is an example of the market forming a new downswing without a down bar. And this is an example of the market forming a new upswing without an up bar. The market has been forming regular swings with up bars and down bars. This bullish outside bar broke above the last swing high. There was no up bar. However, as the last swing high has been broken, despite the lack of an up bar, we must recognize that a new upswing has been formed. And here is an outside bearish bar marking a new swing. Let's take a look at another price swing example and see which shows the correct price swing. Is it A or B? Example B is the correct one. Although this point might seem like a swing low, it is not. Typically, an outside bar doesn't end or start a price swing. However, without a down bar or a break below the last swing low, an upswing will continue. So why is this analysis important? Well, if you understand how the swings are marked and you have learned to identify market swings clearly, you can confidently state the current direction of the market wave at any point in time. This is an important first step to uncovering the market bias. The next step to determine market bias is establishing swing pivots. Swing pivots are the turning points of each market swing. The point where an upswing turns down is a swing high. The point where a downswing turns up is a swing low. Why are swing pivots important? Well, swing pivots are price points that turned the tide of the market. These points are not random. They represent a momentary change in the demand and supply forces. In this example, bulls couldn't move the market above this swing high, not even for one tick. This means that at that point in time, no one was willing to offer a price higher than the swing high. Traders saw no value above the swing high and didn't want to buy above the swing pivot. Hence, when the price moved close to or above a swing high, we must remember that traders saw no value in buying above that point previously. Assuming that most traders have not changed their opinions, prices are unlikely to move above the swing high. So the swing high marks a price area that resists the market from moving up. This is what we call a resistance area. In the case of a swing low, the bears couldn't push the price below it. This occurrence implies that no trader was willing to sell below that particular price point. The reason was that traders perceived value below the swing low. They want to buy value and not sell it. So when everyone wants to buy and no one wants to sell, price goes up and we get a swing low. The logic we applied to analyzing swing highs works for swing lows. When the market falls near a swing low, assuming that traders still see value in buying below the swing low, prices are unlikely to fall below it. The swing low supports the market and is a support area. The failure of swing highs and lows to hold up at resistance and support respectively leads us into another concept. Failed resistance turns into support, and failed support turns into resistance. When a resistance level projected from a swing high fails to block a market from rising higher, it turns into a support area. This is because despite its failure, the price point remains memorable to market participants. A price point that has failed decisively as a resistance will then serve as a reliable support. You can apply the same logic to failed support. After failing to hold prices up, they serve as a potential resistance. Here we have an example of a failed resistance turning into support. We used swing highs to project possible resistance levels. The market rose above with ease, crushing the resistance. The failed resistance then became a powerful support zone. In a nutshell, there are two keys in reading price action. Evaluate how likely a swing pivot will hold up as a support or resistance, and understand the implication of a swing point not holding up as a support or resistance. This might seem very easy and basic, but is one of the most important concepts in trading. Tracking market swings and understanding what they are telling you about the market are foundational price action trading skills. Many traders follow market swings in a wrong manner and find them useful only in hindsight. They are unable to apply the concept of market swings in real time. With this simple approach, you will know exactly the current price wave you are in, and with a solid understanding of support and resistance and confluence of swing points, you will find the best areas on a chart to trade from. As always, if you learned something new and found value, leave us a like to show your support, subscribe to our channel, and click the bell icon to stay notified when we upload new videos. Until next time.